Let's move now to advisory services and corporate finance. The first service to look at is mergers and acquisitions transactions. Mergers and acquisitions, or M&A, are transactions relating to the consolidation or purchase of companies. Though they're lumped together, mergers and acquisitions are very different. Looking at a merger, let's say we have two companies, Company A and Company B, and as the name suggests, they're looking to merge to form a new company, AB. This can happen between two companies of equal size, which is called a merger of equals, but this is uncommon. A merger usually involves a larger company combining with a smaller company. In a merger, the two companies combine and emerge from the transaction with a new name, and also new shares are issued under the new entity. In terms of the actual execution of the transaction, mergers are usually friendly transactions that are negotiated between the two companies. Finally, in terms of leadership, the management team that handles the newly merged company is usually comprised of management from both sides. Turning our attention to an acquisition, here Company A is looking to buy Company B. The way that an acquisition differs from a merger is that the two companies do not combine to form a new company. Instead, Company B is absorbed into Company A and ceases to exist on its own. In an acquisition, the target company is absorbed by the acquirer and takes on the acquirer's name. The target company shareholders may trade their shares for the acquirer's shares if the purchase is made with a stock-based transaction. If the purchase is cash-based, no new shares are issued. Further, acquisitions can often be hostile and be seen as a takeover. This is where the term hostile takeover comes from, as the target company has no choice but to be acquired. Finally, in an acquisition, management is entirely handled by the acquirer, who can choose to keep the target's old management or can replace it entirely. Here's a summary table that is a useful reference of the differences between mergers and acquisitions. You can pause the video if you'd like to take a closer look. There are a number of reasons why a company would want to undergo a merger or an acquisition. The first is synergies. Synergies mean that the sum of the parts are greater than the whole, meaning the companies are able to support each other in a way that would create more benefit versus one company trying to grow into a particular market on their own. For example, the merger between Whole Foods and Amazon gave Amazon the expertise and experience to move into the online grocery market. The second reason is growth. Companies can choose to acquire or merge with other companies to generate growth rather than to pursue organic growth. Acquisitions are a great way to gain market share. The third reason is economies of scale. This comes along with growth. Economies of scale means that costs tend to go down as a company gets bigger. For example, the company is now able to make purchases in larger sizes, which usually earns bulk purchasing discounts. Or, the company could be spreading out certain fixed costs across more production, thus lowering the overall cost per product. The fourth reason is asset acquisition. Sometimes, companies may have assets that are hard to acquire normally outside of an acquisition. This usually relates to new technologies. The fifth reason is elimination of competition. While expensive, one of the best ways to get rid of your competition is to simply acquire it. The sixth reason is diversification. Acquiring or merging with other companies is a great way to move into other markets through horizontal integration, or to take control of the supply chain through vertical integration. Finally, M&A can have certain tax advantages. If a company is acquired that has carry-forward tax losses, those tax losses will apply to the acquirer, thus reducing their tax liabilities. As M&A transactions are complex, they require the help of an investment bank. Depending on whether the bank is representing the buyer, the acquiring company, or the seller, the target company, the deal can be considered a buy-side deal or a sell-side deal. First, let's look at buy-side deals, as those are probably what you're more familiar with. In a buy-side deal, the investment bank is representing the acquirer. In this case, the bank will source potential targets and deals that fit the buyer's needs. For example, if the buyer wants to diversify into new global markets, the company may purchase a similar firm in a different region. The investment bank will conduct due diligence on prospects to make sure the firm has presented itself accurately and that it truly is a good acquisition. Part of this process includes valuing the target company and valuing the synergies acquired by the transaction. If required, the bank may also need to help the acquirer raise capital for the transaction by issuing new securities into the market. Finally, the bank needs to negotiate and execute the deal on behalf of the buyer. Now let's take a look at what an investment bank does in a sell-side deal. In a sell-side deal, the bank is representing the target, which is looking to sell its company. In this situation, the bank will help prepare the company's financials, projections, and marketing materials. The bank wants to make the company look as appealing as possible as a target. This will help them pitch the company to possible acquirers. The bank will also provide what it believes to be a fair valuation of the target company to be negotiated upon. Finally, the sell-side investment bank will negotiate with the buy-side bank to execute the deal. The attractiveness of M&A transactions is that they can happen multiple times for the same client, and so there is some retention and repetition for this type of advisory service. However, it's important to note that the fees differ depending on what side of the deal the bank is on. On both sides, banks get a retainer fee which is paid to use the services of the bank. This fee is guaranteed and covers some of the costs of the transactions for the bank. Banks will charge a retainer fee that can be anywhere between $50,000 to $250,000, or its equivalent currency. Both sides also get a success fee, but this is where it differs. On the buy side, the success fee can be somewhat uncertain, as it depends on the bank closing the deal. However, buy-side transactions can often fall apart since the buy side is only focused on a single seller, while the seller can have multiple bidders. Because the sell side has multiple bidders to choose from, their deals will typically continue to completion, so the success fee can, in a sense, be considered guaranteed. Deal sizes of 1 to 5 million can expect a fee of 8 to 12%. Deal sizes of 5 to 25 million will have success fees of between 4 to 7%. And deal sizes of 30 million to 100 million will incur a success fee of somewhere between 2 to 4%. Here are a few examples of some somewhat dated but famous M&A deals. In 1989, Time Inc. and Warner Communications merged to form Time Warner Inc. at a cost of $15.2 billion. In 1998, Exxon and Mobil merged to form ExxonMobil, the oil and gas giant, a $77.2 billion transaction. And more recently, in 2009, Disney acquired Marvel Entertainment for $4.24 billion. Another advisory and corporate finance service relates to restructurings. Restructurings are when a company makes significant changes to its financial structure. This most often happens when it may not be able to meet its liabilities to its creditors. When this happens, companies rely on the services of investment banks to help them renegotiate and restructure. When a company doesn't have enough cash or liquid assets to cover its debt or to cover its interest payments, it can fall into distress situations. Distress can occur when the company misses an interest payment or a principal repayment. Both of these are incredibly severe and are considered defaults. Additionally, if a company breaches the covenants set in their debt contracts, they can also fall into distress. All three of these scenarios can trigger a restructuring. There are two types of restructuring: debt restructuring and organizational restructuring. Most of the time, when we refer to restructuring in investment banking, we're talking about debt restructuring. In a debt restructuring, the company tries to negotiate with creditors to change its debt terms. Creditors usually accept this because they would prefer to get something over nothing. In these cases, both parties may come to an agreement to reduce the debt load that the company has to take. For example, the new debt terms could include a different payment timeline, reduced interest rates, or a reduced principal amount. If the company truly cannot come to an agreement with its creditors, it may need to file for bankruptcy protection. The other type of restructuring is organizational restructuring. In this situation, a struggling company seeks the advice of an investment bank to improve its organizational structure. In this case, the bank acts like a consultant, providing recommendations to improve the company's financial health. These recommendations can range anywhere from replacing management or selling off assets to even changing the company's strategy. Like in an M&A deal, investment banks represent two different sides in a restructuring deal: the debtor and the creditors. On both sides, investment banks work hard to conduct due diligence on the company's financials, growth, and revival prospects. They both use valuation to assess the company's true value. Where they diverge is in their goal in conducting these analyses. The bank representing the debtor is trying to present the company's resurgent strategy in the most favorable light to pull the negotiated credit terms in the company's favor. Meanwhile, the bank representing the creditor is trying to find weaknesses in the company's restructure plan so that they can get better terms for the creditor. Like with the other services, banks charge companies sizable fees for restructuring services, as they can take a significant amount of resources. In a restructuring deal, there are typically 3 different fees that a bank will charge its client, and they are similar in function and amount to M&A transactions. First, there's the retainer fee. As mentioned in the M&A section, this is a periodic fee, usually paid monthly, that is paid to retain the services of the bank. Next, also like an M&A transaction, are success fees. These are fees that are only charged if the transaction goes through. Where it slightly diverges from an M&A transaction is the third fee, which is the security issuance fee. These fees are charged if the bank also needs to raise new debt or equity capital to assist in the restructuring deal. Usually, these fees tend to be higher than other transactions because it is harder raising capital for a company in distress. If you're interested in learning more about the products used in a debt restructuring, you could always check out CFI's High Yield Bond Subdebt and Loans course that's found as part of the Capital Markets Securities Analyst program. Let's take a look at our diagram for an investment bank's products and services again. Investment banks are considered part of the sell side of the capital markets. However, investment banks also have buy-side components. On buy-side investment banking, investment banks offer asset management products and services as well as trading services. Asset management is the service of investing the funds of other people. Although it is a buy-side service, which typically isn't associated with investment banking, investment banks do have asset management groups. Like with research, this can cause a conflict of interest, so a Chinese wall is enforced, limiting communications between asset management and the bank's sell-side operations. As a quick rundown, asset management involves multiple investors pooling their money with an asset manager into a fund. This fund is then used to buy securities like equities, debt, or even derivatives. By pooling their money, investors can access more expensive options than they would on their own, as the fund can buy securities and allocate a percent of its value to each investor based on the proportion of their contributions. Additionally, the investors gain access to the specialized investing knowledge that fund managers have. If the securities purchased by the funds increase in value, the returns are passed back to the investor. However, in exchange for their expertise, the fund manager will take a cut in the form of fees. Trading refers to the execution of orders in the capital markets. Traders work closely with asset managers to buy and sell the securities for the fund. We can make a few additions to our previous diagram to show this relationship. As mentioned, investors pool their money with the fund manager. The fund manager decides the strategy, risk criteria, and allocations of the fund. With this in mind, traders execute on the fund strategy by buying and selling the securities within the limitations they're given. Traders will specialize in different sectors of the market, as different sectors will have different nuances that require specialized knowledge. It's the trader's job to execute on the fund strategy in the most optimal manner, trading at the most favorable prices. Thus, traders need a deep understanding of liquidity and the sectors that they trade in. Let's recap what we learned in this course. We first looked at banking for consumers. In this section, we looked at consumer products, such as checking and savings accounts. We also explored consumer credit products, such as credit cards, loans, and lines of credit. We also spent time talking about private banking, which is consumer banking for high net worth and ultra high net worth individuals. We then looked at the consumer banking fees associated with these products to determine how banks make money from them. Next, we looked at banking for businesses. In this section, we defined what business banking, commercial banking, and corporate banking means. We explored the needs of businesses based on their size and complexity, and we explored all the products and services used to fulfill these needs. We dove into the products and services related to these needs, such as those related to financing, treasury, trade finance, syndicated loans, and more. Finally, we looked at investment banking and corporate finance. In this last section, we defined the components and groups of an investment bank. We then looked at the most common products and services offered by investment banks. We also examined the differences between the sell side and the buy side when dealing with certain products and services. This course was designed to give you an overview of all the products that bankers in different groups work with. This knowledge will be incredibly valuable as you decide to take more courses, specialize your knowledge, and decide your career path as a financial analyst. We hope that you enjoyed this course on banking products and services, and we look forward to sharing in your learning journey as you continue towards achieving world-class financial analyst status.